Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. There are so many different types of opportunities for investors. We talk a lot about shares, about property, bonds, a bunch of other asset classes. But what about private equity? What is it? Where are the risks and opportunities? And how should investors think about it? To find out, we've gone to someone who knows this space almost better than anyone. I'm joined today by Rainer Ender, Global Head of Private Equity at Schroders Capital. Schroders has more than $90 billion in assets under management, with private equity a big part of that. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Rainer Ender, welcome to Fear and Greed.
Thank you, Sean. Pleasure to be here.
You're visiting Australia at the moment, is that right? Normally Zurich-based?
Correct. Traveling 3 times a year for 2 weeks through Asia to visit clients and looking at investment opportunities at the same time.
Fantastic. So let's start with the basics, a 101 on private equity. What is it exactly? What are we talking about when we say invest in private equity?
It's pretty simple. Basically, if you think of public equity, it's shares and you own the equity of a company that is listed on the stock exchange. Private equity is participating in the equity of any company that is not listed on the stock exchange. And this is a market that has been growing for over 40 years now into one of the main so-called alternative asset classes.
If you think of that universe that you've just described, that is a lot bigger than listed stocks. When we're talking about the different types of assets, obviously we can think about companies, but it's much broader than that.
Yes, basically on company level, for private equity as pure play topic, we would start on the very early stage of founding a company, so startup financing, right? That is called venture capital. Examples would be Google in 1998, got a financing round of $40 million, and that was all they needed to get to their IPO in 2004. And ever since, everybody knows them. Then there is businesses that have grown on their own, bootstrapped as we call that, but then at some point want to grow faster, and the entrepreneurs are looking for additional capital injection for an acceleration of the growth. That would be growth equity investments, and that can be for businesses that have good revenue but are at the edge of being profitable or even already profitable but want to grow further. And then there is a market where it's about owning and controlling a business, which means you take majority control and are the majority owner, and that is called buyout investments. So the buyout space is the largest segment of the private equity market, and that again can be split into very large transactions, the multi-billion-dollar enterprise values, which is called large leverage buyouts, run by firms like the KKR, etc. So the very large brand names that pursue such transactions. And then there's a much larger number in universe in smaller businesses, which are normal family businesses that need a new ownership structure. And that's where we see the most clean private equity philosophy of really helping businesses to grow and continue under a more institutional ownership.
Okay, so let's think about return and risks here. On the return side, how has private equity performed in more recent times? And the background to this, of course, if you think of public markets, the tech stocks have done really well, particularly the big 6 in the US, but many other equities haven't done so well. Listed equities haven't done so well. What about private equity? How's that performed over the last decade or so?
Yeah, that's a very important question and important point. So private equity over the last basically 40 years since it started has consistently outperformed public equity. We call this the illiquidity premium. So because why would investors invest in something that is less liquid if they don't get more for it, right? And private equity has delivered to that. So that's in the long run. And it's really been very consistent, and also especially in times of more turmoil. So very recently, for ourselves, and we have outperformed the benchmarks for private equity over the last 10, 15, and 5 years equally. Performance has been pretty resilient. Venture capital had to take a bit of a correction in 2022 against its very strong upside development and high performance through COVID. So leveling out and moderating a bit from that super performance. while the buyout space for the larger end had a bit of correction in 2022, and the smaller end in our own portfolio had a very good high single-digit performance even in 2022 and also into 2023.
Stay with me, Rain, and we'll be back in a minute. My guest this morning is Rainer Ender, Global Head of Private Equity at Schroders Capital. Okay, you mentioned liquidity premium. The ability to buy and sell is somewhat less in private markets. That's a risk of investing in private equity. You can't just go and sell your shares on a day. What are is that the key risk? What are the main risks in private equity?
Yeah, so one risk in private equity is clearly you own equity, right? So equity is risk, private equity is comparable risk. The governance structures are a bit different. So basically there's a fund manager who controls the business in the buyout concept, right? And you're invested in the fund that is run by a fund manager who owns this company, basically. And that fund, in the traditional sense, is illiquid. It's a closed-end fund where you make a commitment and then you have to wire the money when it's needed, and you will get back the money when a company is being sold 5, 6, 7 years down the road, right? So that's the liquidity. So you need to be able to park your money for some time, right? Now, this is the traditional way of doing private equity. Closed-end funds, limited partnership structures, it's called. The institutional investors put 10 million or even more commitment into an individual fund to be participating in this. More recently, the market has opened up also for the wealth channel for individual investors, also with structures that have some semi-liquidity. And the goal there is really to make private equity more accessible. And there's basically 3 things that are a challenge. First of all, not every individual can commit 10 million, so you need to have a lower minimum amount to make an investment. And that is now, we have a fund in Australia on the market as well. For that investor base, it's 20,000 Australian dollars as the minimum investment amount. Second is the administrative burden. In the institutional way, you get capital calls, you have to wire money, you get money back, you don't know when, and so forth, and you're locked up for a contract of 12 years. In the new way of form, it's a so-called semi-liquid fund. It's much closer to a mutual fund, but with restrictions on when you can redeem. And in the normal case, you can redeem every 3 months with a notice period of 3 months. And the redemptions in aggregate cannot be more than 5%. That's the kind of rules of a typical semi-liquid fund. And with that, the entry barrier is lower, the liquidity issue is lower, and the administrative burden is lower. And that makes the whole private equity market more accessible to individual investors.
And are you seeing at Schroders Capital an influx of that non-institutional money into the market? Because we certainly talk a lot more about private equity.
Yes, that's indeed a major trend, right? So if you think endowments, they own half of their asset base in alternative assets, mainly private equity, institutional pension funds, insurance companies, meaningful allocation to private equity. And the wealthy investors, they've been a bit left behind and are now catching up, thanks to the regulatory structures that are improving and making this possible more easily.
Okay. So you mentioned Google earlier on, and I mean that you said a $40 million round, it's now worth $1.7 trillion or thereabouts. That's a great example. Have you got some other examples that mean good and the bad? Because of course, if I'm investing my $20,000 or $100,000 in a manager, I'm relying on that manager to pick a company which they can add value to. And there's always a risk in that as well. So have you seen some, the good and the bad?
Yeah, so basically we again have to differentiate between different segments of private equity.
Yep.
Google is obviously a venture example and one of the very, very best as a venture investment, as well as now as a public stock for the last 25 years, right? Today you have 1,000 unicorns, which is venture-backed companies that are worth more than 1 billion. Some of them are very well known. Some of them may still have to prove themselves. Revolut would be an example from Europe, which is a challenger bank, right? Some people may know them as a credit card provider with no FX spreads for the clients. So very popular thing and trending upwards. Had a very high fundraising round in 2021. Had to be downward valued a bit since then, but the business is doing well. That's venture, right? So there's lots of later stage venture companies nowadays that are very visible, that are also used by consumers, etc. On the small buyout side, as a contrast, these are typically businesses that are hidden champions in a certain very specialized market. And if they are not in the consumer space, nobody would know them, right? We have had if I just take a very simple but interesting example, a small heating, ventilation and air conditioning business in the Chicago area that we owned through a direct investment of ours. You would not imagine to make much money with such a business model, but this was a perfect buy and build execution by the management, right? Adding on smaller businesses and building a bigger platform as a service organization. And this alone made a high money multiple for us in a very traditional industry. So the spectrum is very wide, right? And sometimes you also don't make money and you may lose some. That's also why diversification is very important, and diversification can be well achieved if you invest through the right structures and funds. Certain funds, especially ours, we focus on a broad diversification as an investment portfolio into smaller businesses, all with ambitious growth. Some will perfectly succeed, some will succeed somewhat, and a few will fail. Right.
Yep. Rainer, thank you for talking to Fear and Greed.
Well, it was a pleasure.
That was Rainer Ender, Global Head of Private Equity at Schroders Capital. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.